In 2008, the world witnessed a financial meltdown that shook the very foundations of the American economy. Banks were collapsing left and right, and people were losing their life savings in the blink of an eye. But what happened recently was even more shocking. The second biggest banking failure in U.S. history occurred, and it was a disaster of epic proportions. The Silicon Valley meltdown. The Silicon Valley Bank just closed its doors, and it's not looking good. This is not just another bank that has failed, but it's the second largest U.S. bank failure in history. I mean, we're talking about a bank that held $209 billion in assets at the time of its collapse. That's a massive amount of money, and we need to understand what's going on here. The first thing we need to realize is that this is not just some random event that happened out of the blue. There have been some warning signs for a while now. SVB has been struggling to keep up with the changing market conditions for a few years. They were heavily invested in the tech industry, and as we all know, the tech industry is not always stable. There have been some ups and downs, and it seems like SVB was not prepared for the downs. With companies like Google, Apple, and Facebook leading the charge, it's no wonder that the valley has become synonymous with success and prosperity. But as we all know, with great success comes great responsibility, and it seems like Silicon Valley forgot that crucial lesson. The banking system in Silicon Valley has always been a bit shady. Banks have been known to turn a blind eye to the risky behavior of their clients in order to make a quick buck. And for a while, it seemed like this was working out just fine. But then, the bubble burst. The sad part is that SVB's failure surpassed those of Continental Illinois National Bank and Trust in 1984, which was $117.2 billion, and First Republic Bank in 1988, which was estimated to be around $83.6 billion. Now that's a huge blow to the financial industry, and it's going to have some serious consequences. We're talking about a bank that had some of the brightest minds in the business, and they still couldn't make it work. It just goes to show you that even the best and brightest can fail. It's not just a matter of being smart or having the right strategy. It's about being able to adapt to changing market conditions. Now let's see, what exactly caused the failure? Now being the primary regional bank serving Northern California's technology firms. It was a big player in the industry, and many tech startups relied on it for funding and support. However, things took a turn for the worse when it reported losses of $1.8 billion in a bond fire sale. That's a massive amount of money, and it was clear that something was seriously wrong. Clients started withdrawing their deposits, which only made things worse. The bank was put under the control of the Federal Deposit Insurance Company, or FDIC, and insured clients were promised access to their funds by March 13th. However, that didn't change the fact that SVB had failed, and many people were left wondering how this could happen. The sad truth is that the failure of SVB is just the latest in a string of banking failures that have plagued the industry in recent years. Silvergate Bank, which focused on banking the fluctuating crypto industry, announced it was closing mere months after FTX, one of its key clients, imploded in what federal prosecutors have called a large-scale fraud. This is a worrying trend, and it's hard not to feel anxious about the state of the market. So, it's a complicated question, and there are no easy answers. Some have pointed to the bank's heavy exposure to the tech industry, which can be volatile and unpredictable. Others have suggested that the bank was simply too big and too complex to manage effectively. Whatever the cause, the result is the same. A once great institution has fallen, and many people have been left reeling. But there are lessons to be learned from this. You see, the tech industry has been booming for years, and everyone was so caught up in the hype that they forgot to look at the bigger picture. We were all so focused on the unicorns, the billion-dollar startups, and the flashy IPOs that we forgot that there's more to the market than just these success stories. Silicon Valley Bank's failure is a wake-up call for all of us. It's a reminder that not every startup is going to make it big, not every idea is going to be successful, and not every investment is going to pay off. The bankers need to start looking at the market with a more critical eye and start investing in sustainable long-term solutions. But it's not just about startups and entrepreneurs. It's also about the investors and the banks. We need to start taking a more responsible approach to investing and stop throwing money at every shiny new idea that comes along. We need to start looking at the fundamentals, the business models, and the potential for long-term growth. And for the banks, this is a wake-up call to start taking a more proactive approach to risk management. We can't just rely on the hype and the success stories to drive our investments. We need to start looking at the risks, the potential for failure, and the impact that a failure can have on the entire industry. This is a difficult time for the tech industry, but it's also a time for reflection and learning. We need to take this failure as an opportunity to reevaluate our approach to investing and innovation. We need to start looking at the market with a more critical eye and start investing in sustainable, long-term solutions. We can't just rely on the hype and the success stories to drive our investments. So, what is the one big lesson that we can learn from the recent meltdown? We can learn that the tech industry is not invincible, that not every idea is a good one, and that we need to start taking a more responsible approach to invest. It's time for us to start looking at the market with a more critical eye and start investing in sustainable, long-term solutions. Now, what will the failure of SVB mean for the rest of the banking industry? Well, to put it simply, it's not good. You see, SVB wasn't just any old bank. They were a specialized institution focused on a specific niche in the market. And if they can fail, what's stopping other banks from suffering the same fate? Wait, before we get into it, let's take a look at some other failures. Maybe that'll give us a bit more insight into the case. The most recent example is Washington Mutual, which was acquired by JP Morgan Chase at the height of the financial crisis. This move solidified JP Morgan's dominance in commercial banking, but it also created legal headaches for the bank. The failure of Continental Illinois in 1984, at the time the biggest bank failure in U.S. history, led to federal agencies providing unusual support to creditors, giving rise to the phrase, "too big to fail." These examples show us that major bank failures can lead to significant changes in the industry. Now, let's come back to Silicon Valley Bank. This bank was once a darling of the industry, known for its innovative approach to banking and its focus on tech startups. But things started to go wrong for the bank when it began to make riskier loans to startups that were struggling to stay afloat. As more and more of these loans went bad, the bank found itself in a precarious position. Eventually, the bank was forced to declare bankruptcy, leaving its customers and employees in a state of shock. The collapse of Silicon Valley Bank has prompted concerns about several other banks, with many people worrying about the potential for contagion. Will other banks that have made similar loans to startups be at risk of failure? Will customers of these banks be left in the lurch if their bank goes under? These are all valid concerns, and they highlight the fragility of the banking industry as a whole. But it's not just startups that are at risk. The failure of Silicon Valley Bank also raises questions about the overall health of the banking industry. Is the industry too reliant on risky loans to startups and other high-risk ventures? Are there other banks out there that are also on the brink of collapse? These are all questions that we need to ask ourselves in the wake of this major event. So, what can we expect in the coming months and years? It's hard to say for sure, but one thing is certain. The fallout from the failure of Silicon Valley Bank will be felt for a long time to come. There will likely be increased regulation and oversight of the banking industry, as well as more scrutiny of the loans being made to startups and other high-risk ventures. There may also be a shift in the way that banks approach lending, with a greater emphasis on risk management and diversification. Anyways, this is the kind of news where we stop and take a deep look. Now, what do you guys think? Do drop your views in the comments section below. We'll meet again in another episode. Until then, bye.